Good morning, everyone, and welcome to August's monthly market session. We're in the dog days of summer. Although, actually, Tammy, we've gotten a nice little reprieve on the weather lately. It actually feels like fall. I'm getting ready for college football. But once again, I am Paul Nalabandian, your local real estate market expert for the DMV and self-taught amateur economic guru. Joining me, as always, on the ones and twos, moderating the chat, Temi, all smiles like Koji. Let's see if her latest nomiker is well-deserved today. How are you doing, Temi?
Doing good, and I actually enjoy the heat. So anything below 80 is unacceptable in
Uh-oh.
August.
You and my wife are the same. I want 72 degrees. I want to wear shorts all the time. Don't want to be cold. Don't want to be hot. As we are letting people jump on this morning, I'm going to go into my recent little tradition and share what coffee I am drinking today. It is a white honey geisha from Sebastian Ramirez in Colombia by way of Luminous Coffee in Las Vegas. A truly delicious cup. If you've been joining me every month, you might know that I had a Sebastian Ramirez white honey geisha maybe a month or two ago from a different roaster. Third different roaster I've gotten the bean from because it is absolutely delicious. All right, let's get jumping into
Morning,
our
Maggie.
session. Yeah, I always forget. I need to write a script. So if anybody who's on, can you please let us know your name, where you are joining from? I'd also like, and Temi, if you could keep track of this, if people chime in, would love to hear what you would like to get out of it. I have the set format, see right here, that we're going to cover, but this is also a live organic bean. I want to adapt to cover what people are concerned about, what's going on in the market. I love to hear just kind of what is happening right now, boots on the ground, offers you submitted this past week, because the most recent data I can pull, other than like live data in the MLS, which has some limitations, most recent data I can pull is from the prior week. And all of us on here have more recent information than that. So would love to hear it. We are going to follow the same format as we usually do. We're going to start off looking at the economy. Why do we look at the economy? Because it impacts mortgage rates. From there, we're going to go into real estate specific data covering the DMV most recently reported month of July. Then we're going to hit early August data, look at how the new administration policies are affecting real estate, follow up with some key takeaways, and have some great conversation along the way. Live conversation with me and Temi, and then chat interaction conversation with all of you. So thank you for joining us, and let's go ahead and get started. So where are people seeing mortgage rates? I'm not sure if Mark Linkowitz is on with us right now, our resident lender expert. If he is, I'd love to hear where his most recent locks have been at, both for condo, fee simple, DC, Maryland, Virginia. And I'd also love to hear from all of you. Where are we locking at? Who's had clients locked this past week, and where are they at?
I got 6.6 on one of my clients 2 weeks ago. I know
Okay.
interest, yeah, 6.6.
Yeah, August 1 is when the drop happened. And so that's right around where we are right now. Good morning, Samir. Good morning, Maggie, Chris, Chiquita. Great to have you all with us this morning. And so you can see here, I've been talking about this for a while. The only thing you can expect out of mortgage rates now is volatility. And you've seen that just kind of a little up and down, bit of a yo-yo. We had a quick decline at the beginning of the month. We're going to talk about why in just a bit. But right now, as of yesterday, I think this was the day before that I pulled these. As of yesterday, I think Mortgage News Daily was reporting 661. As always, I use Mortgage News Daily because they report rates on a daily basis. This isn't the mortgage rate. It depends on your clients. If you're looking for condos, the rates tend to be a little bit higher. Fee simple lower, obviously, VA on here lower, and then depending on their debt to income ratio, credit score, all of that. They're reporting 661, so not much has changed, but we have had a meaningful decline. So where we were at last month, we were about 25 bips higher on the 30-year, and most other products were between 20 and 25 bips higher. So we have seen a meaningful drop, and this has a cascading effect in other areas of the real estate market. All right, now we're going to talk about the economy as a whole and what all is factoring into this. How are people feeling about the economy? Are you feeling better or worse since we last met? The same? Don't care? Would love to hear. Oh, 6375.
Yeah.
Maggie, I'd love to hear location, and that's got to be fee simple, I would assume.
Is it VA? Is it FHA? What was the mortgage type, Maggie?
Yeah. Oh man, this coffee is good. I'm telling you, it is. Sebastian Ramirez White Honey Geisha. It is delicious. Maybe I'll bring it in. Oh, by the way, sorry to get a little too off topic here for everybody else outside of Fulcrum, but my intention is to come into the hub next week, bring my little girl so you can all meet her, and might bring some delicious coffee as well.
Oh, Maggie got 6.3 on a conventional.
Conventional. Okay. And like I said, that's got to be fee simple, I assume. Great to have you with us, Virginia, our wonderful principal broker for Keller Williams Capital Properties. Oh, quick pause. Sorry, a little all over the place. Today, I would like to thank Universal Title. I always want to say Universal Studios because I am in Universal Title's Old Town office using their incredible studio. I don't know if you noticed the beautiful environs I am in right now, but a wonderful studio. Thank you so much for letting me use it this morning for my market session. Okay.
Maggie just put in that they put down 60%. So that could be why they got the 6.3 interest rate because I haven't seen that yet.
Mm-hmm. Yeah. Yeah, that's definitely, so that's an outlier. Folks out there, don't be expecting 635s unless your clients are putting down a chunk of change. All right, super quick. I know we have a lot of people joining us every month. If anyone is new this month, why do I talk about the economy? Well, I talk about the economy because you need to understand what is going on at various points of the economy to have an idea of where mortgage rates are heading. I break it down. This is overly simplified, but essentially, what is the economy? It's employment, inflation, retail sales, manufacturing output, industrial production. And that's a major component. And then we also have Federal Reserve policy. Federal Reserve policy is both influenced by the economy and influences the economy. And what are the levers they have to influence the economy? You have the federal funds rate, quantitative tightening, quantitative easing, also called QT/QE. That is where they either buy a ton of assets or let them expire or release them. Just not to get too far into the weeds, but this is the reason why mortgage rates were so unbelievably low during the pandemic. The Federal Reserve was buying billions and billions and billions and billions and billions and billions and billions of dollars of U.S. Treasuries and mortgage-backed securities, thus artificially lowering the rate of return needed to make that a competitive product on the market and allowing lenders to offer lower mortgage rates. So then you have the economy, Federal Reserve policy, and kind of tariffs, trade policy. I've added that because that's become a much more impactful lever. All of those together affect what is happening in the bond market. Mortgage-backed securities are part of the bond market. Most conventional mortgages are packaged into securities. They need to be sold on the open market to investors who are looking at other investments as well. So they're competing. Their price structure has to be competitive to other products. There's also the 10-year treasury, which is a little bit of a safer investment. So all of that impacts the bond market, impacts mortgage rates. If you understand all of that, you'll have a better idea of why mortgage rates are at where they're at and where they're headed. If you don't care to look into all of that, just join me every month or check my weekly market minutes, and I'll give you a quick little snapshot of why. A little more detail if anyone wants to take a look in the deck. Okay, now rolling into the economy. We had the advance estimate since we last met, end of July. The advance estimate for Q2 was released, and that came in at 3%. So a strong rebound from Q1. Q1, we had a contraction of the economy, a slowdown at negative 0.5%. A good rebound, 3% is a very healthy quarter of GDP. So that's nice, but things still aren't that rosy looking forward. We'll talk about more when we get into jobs, but there's just a lot of uncertainty in the actions the administration will take or which will stick. So just tons of uncertainty in the economy, in the market, and all of that. Right now, the Federal Reserve of Atlanta posts a GDP estimate. Right now, their estimate for Q3 2025 is 2.3. Always want to note with this estimate, and you can see in the band there, that GDP Now model is always higher always higher than other blue chip estimates. The closest I've seen it is where it's right at the top in this little blue band, where their estimate is right at the top. Here you can see it's above the high end of the estimate. Other blue chip estimates are estimating anywhere from like a mild contraction of the economy up to a little under 2%. But do want to note the GDP Now model was pretty accurate with where the advanced estimate came in. But good reference point. That's why I look at it each month, just to get an idea. So at least as it stands now, the models are projecting, most models are projecting some slight growth in the economy, which is good. So consumer price index, you have the all items monthly change increased by 0.2%. Consumer price index is inflation. This is in inflation, one of the key metrics for it. The 12-month all items change was a 2.7% increase. And so for the monthly change, shelter was a primary driver. That's been the case for quite some time. But all of these numbers, we are seeing the tariffs make their way into inflation. There are two reasons why these numbers aren't higher, even though they're elevated. We have finally kind of gotten inflation under control. Tariffs are countering that and pushing prices back up. They would be even higher, except for two things. One, businesses are absorbing a fair amount of these costs right now. They can only do so for so long. Most of these large businesses are publicly traded companies. They have to answer to stockholders. But so far within the supply chain, businesses are absorbing a lot of these increases. And then the other thing, so prices did go up. We are seeing an increase in prices, but energy and gas costs were down by a fair amount. So that countered some of the price increases in consumable goods and all of that. I've been touching on this for a while. It's so important. Going to hit on it again really quickly. How accurate is this inflation data? And the answer is, I don't know. I mean, so I would say not accurate, but that would be a little alarmist. I will just say here, you can take a closer look in the deck, but super quick. As I mentioned before, with government cuts, the Bureau of Labor Statistics, which you might have never heard of before I mentioned it, but have been hearing about it a little more in the news right now. The Bureau of Labor Statistics had a hiring freeze a while back. And I mean, this year, post new administration, the hiring freeze caused them to not be able to have the same reach they did in checking prices. Now they don't have the capability to check all of the prices they need to in order to come up with these inflation numbers. And so they're using what's called different cell imputation. If they need a price for something and they don't have the manpower to check that price, then they take the price of something similar and impute what the cost would be of this. Why is this important? You don't need to understand anything more about this than just to say different cell imputation means educated guess about price. And here's a chart. I included this chart last month, updated now for this month. Mentioned last month that Bloomberg was calling this chart the most worrying economic chart in the world. And the reason for that is it is showing for the past 4 months, more than 30% of the prices that make up the CPI calculation have been guesses. Prior to that, 10% was really the upper limit, and usually it was less than that. So a much greater portion of these prices are made up of educated guesses, and that is continuing, and it really makes you question the credibility of this data, which is really concerning, and I will go more into that in just a bit. So, jobs. I assume people, I mean, I know I'm following this stuff all the time, so sometimes stuff seems like a really big news to me, and it's not necessarily, but I think a lot of people probably heard about the jobs report because of the fallout. The jobs report came in at 73,000 jobs added, and that is, well, if the last 2 months weren't downwardly revised, that would have been the lowest number in a little bit, and you can see that here on the chart. More impactful than that is the jobs reported for May and June were downwardly revised by 258,000 jobs. That's a lot of jobs. And so you see, I've updated the chart here. Now, instead of 100,000 plus jobs added for May and June, they're saying the actual number was 14,000 jobs added for June and 19,000 jobs added for May. For historical context, Those are the lowest. That's the lowest level of monthly jobs added in 5 years, about 5 years since December of 2020. Now, the news you might have heard is that as a result of this, President Trump fired the head of the Bureau of Labor Statistics, which is a little bit alarming. One of the nice things about data in our country is that you could depend on it. It wasn't politicized. We weren't cooking the books to tell one story or another. And the concern among the markets is now there's going to be more pressure by the new head of the Bureau of Labor Statistics to manipulate data in the way that the current administration would like it to be manipulated. I hope that's not going to happen, but a little indicator of whether it will happen is shortly after the president announced his intention for the new nominee. That new nominee went out and immediately floated the idea of suspending the monthly jobs report, just not providing it for a while. So that's a little concerning. And when do I get into this stuff? All right. Trying not to get too far in the weeds, so we'll just keep plugging ahead for now. The unemployment rate up 0.1% to 4.2. It's been between 4 and 4.2 since last May. And so we talked about, like jobs added has been lowering. Businesses are extremely reluctant to hire new workers right now because there's so much uncertainty in what is going to happen. They're concerned about costs. Their margins, as I said, are being shrunk because of these tariff pressures. And so they don't want to take on any additional expenses. But then beyond that, just the landscape of everything is really uncertain and volatile. So a lot of businesses are just putting those decisions on hold. And that's clear. You might think, oh, the unemployment rate is kind of steady. But two important things to note. So one, the number of unemployed people who have been unemployed for at least 27 weeks increased to 1.83 million from 1.65 million in June. And so we had about 200,000 more people who've been looking for jobs for more than half a year and haven't been able to find employment. And then the other is that fewer than half of all industries last month added jobs. And if you don't follow this, that might make any sense. But just to give you an insight into the reason for alarm in that, fewer than half of all industries adding jobs in a given month, that's basically unheard of outside of a recession. In our current economic climate, with estimated GDP where it's at, all the other metrics, that should not be happening. And that really hits home how concerned businesses are about this kind of stuff. All right. Audience participation. Where does the Federal Reserve think the economy is headed? While people think about that, I'll take another cup of this, sip of this coffee. Tell me, where do you think the economy is headed? How are you feeling about it? Are you feeling more optimistic, more pessimistic than you were last month?
I'm always optimistic just because I was just thinking about it yesterday. I was just like, I just really compare everything to the 2008 market crash. I'm like, that was
Mhm.
bad. And so I'm like, what we go through some uptimes and we go through some downtimes. I think we're not, we may not be in the worst of it yet, is my
Mhm.
concern. I know we'll be on better ground later on, but my concern is that we may not be in the worst of it yet.
Yeah. In anyone who has been through serious economic calamity, and you talked about the global recession, and even before that, we had some seriously tough economic times. This is nowhere close to that. But
Yeah.
from where we have been at since '06 to '09, I would say this is the most volatile time, and a time where concern should be relatively peaked. So
And I
Federal
don't
Reserve.
Hey, Paul, one more thing. I don't know if this is a good way to think about this or a bad way. I think of it like, I was taught that real estate goes through a 7 to 10 year like high cycle, and then
Mhm,
a 7 to 10 year or 6 to 7 year like stabilization.
mhm,
And in my mind, there's always something that causes that stabilization, right? Whether there's something going on in the market. And for the last few years, we've been you know, for the last few years, since I think since 2018 or 2019, they've been talking about, we're going to go through a stabilization. We're going to go through a stabilization. Something's about to happen. And we just kept going up and up and up and up and up with real estate. So this forced stabilization to me is like was to me was expected. I just,
Mhm.
we just never know what it's going to look like that's going to force a level of stabilization. So
Mhm.
that's in my mind, that's kind of how I think about this market. I think of it in terms of like real estate. I don't know if that's a weird way to look at it.
No, that's great. That's really insightful. I'm glad you added that. It we saw, I know in our area in the DMV, there was rough appreciation of 40% over the pandemic years. And that was artificially created by the Federal Reserve overreacting to there's a saying, you're always fighting the last war. There's economic consensus that the Federal Reserve had too light of a hand during the economic collapse. And as a result, the economy underperformed for years after that. So when the pandemic came along, like I said, fighting the last war, they underreacted last time, they overreacted this time, pumped so much money into 10-year treasury and mortgage-backed securities, artificially lowered the mortgage rate. That fueled this crazy real estate boom. And so it's not a bad thing if prices stagnate or stabilize a little bit. The problem is, like, when you just have so much volatility, it's hard for people to make informed decisions. And that's the key. Like, whatever's going on,
Yeah.
whatever decision you make, just have it be informed. And it's so much harder right now to make informed decisions. Self plug. That's why I do this. That's why this is more important than ever. We're giving you as much information as possible to help make your decisions if you're a consumer, or your clients' decisions, or provide information for your clients to make their decisions if you are an agent. So uh, they held rates steady. Everybody knows that. Two governors dissented, two officials dissented. These are the two recent appointees who are both kind of jockeying for Chairman Powell's job once his term ends. I kind of discount anything they do because, they're just going to fight for the largest cuts possible and curry favor with the current administration, so they have a better chance of getting that chairmanship. The minutes were just released yesterday, and it appears that other than these two stooges, everybody voted to hold rates steady. So they're more concerned in the statements that were released before. They seem to be a little more concerned over rising inflation than weakening employment. If that's the case, and these are the two things they're concerned about. If they're more concerned about rising inflation, they'll hold rates steady. If they're more concerned about the job market softening and rising unemployment, they will lower rates. That's about as clear as a cheat sheet as I can give you. What was once expected to be a lock for a rate drop in September is now a little up in the air. Virginia mentioned that there's more inflation and expecting kind of a more meaningful set of interest rate drops in the fall winter. There still is an expectation of interest rates dropping, but right now, a lot of uncertainty over what will happen in September. And what once was a slam dunk isn't necessarily the case anymore. Chairman Powell is speaking at the Jackson Hole Economic Conference today, and his comments should tell you what's going to happen in September, or at least give you very good insight into that. 10-year Treasury as of yesterday. I don't expect to see any meaningful change since last night, but I'll go ahead and take a quick peek. Or refresh. 4318. So we've had a little bit of a bump in the 10-year Treasury from yesterday. Retail sales, this matches what economists expected. We saw a bump of 0.5% from the prior month. This was driven by auto parts and sales. Industrial production and manufacturing slowed, kind of stagnated. Not much going on there. Industrial production declined by 0.1%. Manufacturing was basically unchanged. All right, now let's get to the good stuff, what we all do, at least the agents and industry pros among us here in DMV real estate.
We have one question from Maggie.
Yeah. First, just out there, how's the market? How are people feeling about the market? What are people reading about it? What kind of feedback are you getting from your clients? Would love to hear that in the comments. Now, I expect there, Maggie, to answer your question, I expect there to be a lot more clarity after his comments today in what the Federal Reserve will do at the next meeting. I think people will have a little bit stronger insight into whether there will, in fact, be a federal funds rate drop in September or not. So I think that will be more clear. Whether it's crystal clear, I don't know, but I can guarantee you it will be more clear. But that doesn't really get to the root of your question, because the Federal Reserve, while in a normal economy, is the heavy hand that is really the single driving force of change. There's a lot of other stuff always going on in the economy that are impactful, but usually no single thing can make the market move as powerfully as the Federal Reserve, because they're reacting to everything and they're interjecting themselves. Here, right now in the current administration, I would say that's no longer the case. Right now, the heavy hand is the administration and what they're doing with tariffs and what they're doing with potentially removing Federal Reserve officials. I just saw a recent article that the president is alleging misdeeds by one of the federal officials and potentially thinking of firing her. And so that the actions by the current administration are so unpredictable and so extreme. That is really what has the greatest impact in the economy right now, or one of the greatest impacts. And we just don't know what's going to happen. So it's like volatility, uncertainty. That is all that will be certain, at least for the foreseeable future. Okay, I like to start this off with a little historical context. We go up to the 30,000 foot view. What is this year looking like? Well, I can tell you this year right now is looking exactly pretty much like it did last month, and looking pretty much exactly like it did the year before and the year before. And that I'm just talking about in total units sold for the year. Our pace is almost the same as it was last month. And right now we're on pace to hit pretty close to where we were last year, pretty close to where we were the year before. What's going on under the hood is changing a bit.
Mm-hmm.
So the market is changing, but pace, units sold, overall numbers, right about the same. Now, as you can see here, and for any of us who have buyers who are still on the sidelines, I would just like to point out, as I have for every month for the past 26 months, we have had 26 straight months of price appreciation in the DMV. That means there has not been a single month in more than 2 years where metro area wide we have not seen real estate price appreciation. Now, DC has had some down months, and some other areas have had some little blips, but overall prices have been increasing for quite some time. And even as the market is softening and slowing a bit, we are still seeing overall price appreciation. So that's just something to note. Counter to that is you can have a seller's market, but you can have a softer seller's market. And that's really where we're heading into right now. You can see the days on market, median days on market are up to 15. And so that's been a noticeable bump. Last July, days on market were 8. So we've seen it almost double, jumped up by a week. That's not insignificant. Houses are taking longer to sell, but there's still pricing pressure, still a fair amount of demand, but relative to where we've been, homes are sitting for a little bit longer. Like Christina just mentioned, it's almost like we coordinated that comment, which we didn't. Like that joke isn't like a wink to what we did. So very nice. Yeah, buyers are a little bit hesitant. Okay, now jumping into closed sales and new pendings. Both of these you'll see, closed sales and new pendings are pretty close to last year's levels, and those are at the low levels of where we've been at for the past 5 years. And you'll see that with a lot of these metrics. A lot of these metrics were at the low end of where we have been at for the past 5 years. So closed sales, no shock that they dropped. If you're following any of this at all, if you look at pendings for 1 month, whatever they're doing, closed sales are going to be doing for the next month. This past month, pendings were down. So, and when I say past month, I mean the reporting month before last month. So pendings were down in June. This is July data. Of course, closed sales are down in June. And that's continued into July. But so demand was definitely softening. But the jobs report came out August 1, and that led to a pretty immediate decline in mortgage rates. And as a result, we have seen new pendings DMV wide, not in every county, but we've seen new pendings DMV wide increase so far in August, I think by about 8%. And showings also, we'll talk about that in more detail when we get to that point. But we have seen a noticeable uptick. The data is reporting a noticeable uptick in buyer activity. So we should be seeing that on this call. If not, would love to hear what your specific buyers are doing. If you've had, I love to hear when we're on here, people say, yeah, I just, this past week or two, or in the past 3 weeks, or once the jobs report came out, I had these buyers I hadn't heard from in a while and they're reaching back out. Or if your personal experiences aren't matching the data and you have people, some still sitting on the sidelines.
I think it's
Okay,
a little all
new.
over the place. Sorry, I've
Mm,
talked with agents that have felt like, August came in and now it's Christmas for them.
mhm,
Like buyers are coming out of the woodworks. And then I've also seen it where it's like buyers are still in the loop. I personally hadn't had really much. And then when I started to call my people and just check in on them, that's when, people were like, you know what, I'm actually ready to buy. Or like I'll answer one question for them and they're like ready to go. So
mhm,
I think in an uncertain market, you kind of have to do a little bit more legwork to see where people are and then kind of create the environment that you want. But then
mhm.
you'll have some agents where, buyers will come to them. So it's things are still moving.
Yeah,
You may just have to
definitely.
move a little bit more. Yeah.
And this is one of the results of our uncertain climate because buyers are not as confident. Yes, mortgage rates dropped at the beginning of August to a pretty decent level compared to where they have been at recently. But that doesn't mean you get that rate. There's so much volatility. If a buyer jumps back in, then all of a sudden something else happens and rates spike again before they lock. They're still in the same boat. And I think a lot of buyers are just feeling whipsawed and are a little bit
Mhm.
tired of it.
Yeah.
Yep. And Maggie talks about starting to re-engage as yeah. Okay, going back to new listings. New listings are pretty close to where they were this time last year, and they are pretty close to the low end. Like a lot of these metrics, new listings are at the low end of where they have been for the past 5 years. So I'm trying not to be overly agitated, but I keep hearing so many of the same mistaken beliefs or so much of the same clickbait. So let's just look at this and be clear. People are not fleeing the area. They're not fleeing the area. New listings are where they were at last year, and they're at the low end of where they have been at for the past 5 years. So unless they're all renters who are leaving, people are not fleeing the DMV. Okay.
I think so I've seen some reactions based off of what is, put out there on the news. And I think it's really important to be on these calls, to look at the data. And then also you have access to the same data, look at the data before making an assumption. I think it's a flip-flop in emotions because of what you see sometimes in the news. And I even, a client of mine reached out to me and was just like, hey, do you see the report about, there are a lot more buyers that are walking away from properties, like, they go under contract and walk away. And then, but I read the whole report and I was just like, well, the top 10 areas are not even in our area. They're
Mhm.
Florida, California, be like, you have to really look at what's happening in your area. You can't take world news as your news all the time, I
Mhm.
think. Yeah.
Yeah, absolutely. Can't take world news, can't take national news.
Yeah.
It's really rare that I see a national news article that has any relevance to us. Really rare. Occasionally, but I mean it's just really rare. There's a lot of people are feeling the economic impact, and journalists and pseudo journalists are among them. And you got to get those views, you got to get those eyeballs on your articles, and writing a thoughtful piece backed by data isn't always the way to do that. Okay, active listings. That's inventory. What's on the market now? Inventory is almost identical to last month. It was we had 10,245 active listings at the end of June. We're at 10,283, pretty identical, and we're consistent with where we have been. That number is about 40% higher than it was last July. So this is the 18th straight month of DMV wide increases in inventory. But so you'll see a correlation there. I've talked about the 26th straight month of price appreciation, and we're at the 18th straight month of increases in inventory. So you can see that buyer demand is matching some of this increase in inventory because we're still seeing upward pricing pressure. We're still seeing homes go relatively quickly, but this is slowing. So it is. It's supply and demand aren't at the same point as they were 6 months ago, a year ago. Right now, I always talk about 2019 as the benchmark year, the last normal year. And it was not uncommon, not so long ago, when our inventory levels were running between high 50s and low 60s of 2019. So we were like less than 2/3 of the inventory of 2019. Now we're up to about 85%. We are just 15% down from where inventory was at 2019. So we are getting closer to kind of a normal level of inventory. This is all the specific numbers. When you take a look at the deck, want to point out months of supply, 2.48 for the area. That's in red because that's not a lot of meaningful supply. 2.58 months of inventory is a seller's market. Okay, now we're going to break down, we're going to look at county-specific data and cover what is going on in the various areas. And I think that there's a lot of, you'll see when we hear, let's just pop in now, you'll see that things are different in a lot of different areas. If you're someone who practices DMV wide, talk about whipsaw, your head's probably all over the place because it really depends on what your buyers are looking at and where with what their experience has been. So you can see that there's still upward pricing pressure in a lot of areas, but it's softer than it has been. Excuse me. The only area that didn't have price appreciation or wasn't even was Arlington. And I've said this before, like Arlington and Alexandria are a bit interesting because you'll see their median prices all over the place. And it's usually just reflective of a change in the distribution of sales in that given month. And I looked under the hood, wanted to see what was going on here. I know that prices aren't really dropping in a meaningful way in Arlington. And if you just follow any particular price point, you'll see that. But I did see that this past month, double the amount of homes in the 200 to 299 range sold this past July as they did the year before, and almost double the amount of homes in the 3 to 399 range sold than as did the past July. And so a lot of this decrease is just more lower priced properties came on the market in Arlington in July. All right, closed sales. You can see that closed sales are down everywhere except Arlington, where they're up 22%. Loudoun is just a couple percent up. And then DC is up almost 10%. This is something to take note on. DC was the quote unquote slowest market in the area for quite some time. You would see price appreciation in a lot of areas, whereas you would see some depreciation in DC. You'd see higher days on market, more supply, just lower demand relative to supply, whereas DC's kind of stabilizing now and the other areas are weakening. And we haven't, this never plays out for good. This is always a live being, but it'll be interesting to follow that going forward. So closed sales were down big in suburban Maryland, and that is something also to keep an eye on. Suburban Maryland, the demand seems to be softening relative to supply. Closed sales were down 13% in Frederick, and in Prince George's County, they were down 12%. Looking at the new pendings, and this is all data has a little bit of a lag. New pendings will be more recent than closed sales because closed sales have gone under contract, usually 14 to 30 or so days beforehand. So new pendings, you can see that this softening demand is continuing into farther out Maryland, in Montgomery County even. So Frederick and Prince George's are down again. And demand in Prince George's is really softening because if you look at the August data, pendings are down more than 10% year over year in the first couple of weeks of August. So if you are primarily operating in Prince George's County and you're representing buyers or sellers, it's really important to know this. If you're representing sellers, know that you are entering a more challenging market. It's more important than ever to price appropriately. And if you're representing buyers, you know that you might have a little bit more leverage. You might be able to get those contingencies in your offers. And for those of you on the call who focus or at least have some of your practice in that area, I would love to hear if that matches what you're seeing. Frederick, on the other hand, Frederick is a little bit herky-jerky. 1 week in August, pendings were down. 1 week in August, pendings were up big. So it's not clear how the market's going to be shaping out in Frederick.
Definitely feeling it here in gorgeous Prince George's.
Mm-hmm. Mm-hmm.
Yeah. It's just a different feeling, different market. Yeah.
And it's not a bad thing. I mean, equilibrium, it's not a bad thing. Not having this skewed, crazy seller's market like we've had for quite some time is not necessarily a bad thing. It's just important to know. Whatever's going on, it's just important to know and be able to react and be able to inform our clients accordingly. All right, days on market. Now, this is where we're seeing the most dramatic movement in the market. Days on market are increasing everywhere. Days on market are now 11 or more days throughout the area. And I mean, we're going into the summer. It's a slow time. Days on market creep up during the summer. But you can see here within the bars, the days on market are increasing. So they're higher everywhere. They're not only higher from where they have been earlier in the year, but they're higher than where they were at last July. So DC is still the highest days on market by a wide margin at 34 days. That's been the case for quite some time. And days on market increasing by a fair amount everywhere. And about half of all homes in the DMV are still going under contract in 2 weeks or less. So pretty fair amount of demand still. All right, now we're going to look at months of supply. You can see that months of supply is increasing everywhere, but as I've said, and I've been saying this for a while, 75% increase of nothing is still about nothing, and there is still relatively no meaningful inventory anywhere outside of DC. And this, I did it last month because it's just so important. I want to make sure this data is a month behind. Bright doesn't release inventory data on a weekly basis. They only release it on a monthly basis. And so I went in yesterday, manually pulled inventory for the area. And the way I manually pull it, it's not going to be as precise as if you analyzed over a stretch of time, took the average rate of properties going under contract and properties closing, normalized that, and came up with your figures. This is more of a rough calculus, but it's accurate enough for it to be meaningful and helpful. And let me check my notes here to get, as of yesterday, the following areas had less than 2 months of inventory. Arlington at 1.8 months, Alexandria at 1.5, Fairfax at 1.5, Loudoun at 1.3, Montgomery at 1.8. Frederick was a little over 2 at 2.1 months of inventory. Prince George's County was a little under 3, and DC is between 4 and 5. And that makes sense. August is a slow time of year. You'll have some people, if their listings aren't doing well, they might pull temp off, or if their listing agreement has expired, they might wait until the fall. And then if someone has a great listing, they're not necessarily going to want to list it in August. And so that makes sense that we're seeing in those up-to-date recent data, we're seeing inventory levels even a little lower than they have been. But what is the takeaway from everything I just said? Anyone in the comments? I need to start getting some like treats or something I can mail out for incredible comments. What if you had one takeaway from what I just said, what would it be? As we wait for responses in there. Yeah, Christina, that's definitely talk about a concrete instance of a change in time. Christina says earlier this year she had a listing 15 above asking. It fell through. Same listing 2 weeks ago, received a below asking offer price, asking for seller help. Yeah, I also know anecdotally of a situation where not so long ago, property went under contract, deal fell apart, and the buyer, I mean, this is a higher, fairly high price point, but the seller ended up getting like 6 figures less than the original contract. Okay, new listings. So overall, new listings are down a little bit in the DMV, but it really depends on where you're at. You had a slight increase in new listings in like core Nova, Alexandria, and Arlington, but they were down when you get a little farther out in Fairfax, up by 8% in Frederick, 4.4% in Loudoun. They were up by almost 4% in Montgomery County, down by 7% in Prince George's County, and down by around 8% in DC. And this is, like I said, keep an eye on DC. DC had been having increasing inventory relative to the area, and now you can see that DC's new listings are down more than anywhere else year over year. But take that with the historical context in that last year at this time, the DC market was already softer. And so what's happening now in some of the other areas has already happened in a little bit of year. So base effects, it's not apples to apples, but still it's important to note and keep an eye on. Active listings. This is really the one area where we're seeing the same thing throughout the DMV. It just depends on where exactly. Active listings are up everywhere. But like I said, take these year-over-year numbers with a grain of salt, because most of these areas had no meaningful inventory this time last year. And so, 50% change of nothing is still not a lot of nothing. Everywhere increased active inventory, active listings by 40 to 65%, except DC, just a 17% increase. Like I said, so we're seeing the market strengthening a little in DC, supply relative to demand compared to the suburbs. So as we've covered already, in DC, closed sales were up, new pendings were up, prices were even, their new listings are down, and their active inventory is increasing at the slowest rate. And we are
Maggie has a
going.
question.
Yep. So Maggie's asking, can you throw that up on the screen, Temi? Maggie's asking about why what's going on in DC is going on. And I think it's for two reasons. And part of this is just educated speculation on my part. So two reasons, I think, like I said, I think it's base effects. So the change from where they were, DC had already been hit. So they were already depressed market. And because of that, it's if you already had a lower level of closed sales, a lower level of pendings, then you can have an increase on that and still be at a lower level relative to normal than these other areas. So that's what we're seeing. I don't want to say that DC is like a more vibrant market. And when I say vibrant, I mean like sellers market, basically, like supply, demand exceeding supply, a lot of transactions going on. I don't want to say it's more vibrant than the other areas. And so part of that, but it's because base effects. So they were already depressed. And so they're coming from a lower level by comparison. So part of it is because of that. And then the other part of it, honestly, I don't know. Anecdotally, I know enough people who have been forced to be back in the office that it might be that. It might be you had a lot of pandemic moves when people could go out and for the same price as a one-bedroom condo in DC, get themselves a detached home with a yard 90 miles outside of the area. And now that's just, they can't be driving 4 hours a day to and from the office. So that's, like I said, some of this base effects is real. Why the other stuff is happening, what else is coming into play, a little bit of speculation. Okay, now we're going to hit, hey, is Shelly Pratt on here? I'm going to cover something she pointed out to me. So hopefully she is on here. We're going to get to that right after this.
Shelly Pratt is on vacation.
Oh no. Or as my wife and little girl says, oh no. We that's, I would say, with the way Australians, no offense to Australians, I love it, but the way they say no is just endearing to me. And a lot of times, like my girl would be crying and I would say, oh no. And I'm like, no, wait, I don't want her to see that I'm distressed. I want to be able to calm her. And so now whenever we have something that's like that, we say, oh no. And I don't know, for me, that seems a little better. So that was oh no for Shelly being on vacation. You are missed. All right, you'll have to watch this later because this is kind of key stuff. But all right, hitting in the most recent reported week for the DMV, this is what I gave you a little sneak peek, a little teaser on earlier. No shocker, Morgan. Love that, Maggie. No shocker. August 1, I mean, literally the jobs report came out August 1 at the very beginning of the month. Within 2 days, mortgage rates had dropped 25 bips. And now we're seeing showings and pendings up in most areas. Both were up this past week, about 8% year over year. But added wrinkle for those of you who are still with us or watching later, this is more meaningful than you might think because mortgage rates were also dropping precipitously last year. So we were in the same kind of environment. Mortgage rates were dropping pretty dramatically from July into September. So it wouldn't have surprised me if we would be matching those levels from last year, but we're actually exceeding them. And so that is evidence of increased buyer demand relative to mortgage rates. Maybe there's some buyers who can't wait any longer. They're like, we're not going to be able to time this market, so let's just go forward. So there is something meaningful happening in buyer demand other than mortgage rates. I want to point that out. So days on market continue to climb by a fair amount over their levels last year. They're now up to 36 days DMV wide. And this is where days on market is where we're seeing the most meaningful change in this market. So this is only for a week, We don't know how August is going to shake out, and week to week numbers go up and down. But if the August numbers end up being similar to this, and I looked this up because I knew this was a high number, and I couldn't remember the last time I saw a days on market like this, but thought it would be interesting to share. You would have to go back if days on market median days on market for August end up sticking around this level, 36 days. You would have to go back to February. I wish this was live conversation interacting, so I would just ask and wait, but there's too much of a lag. You would have to go back to February of 2016 to find a month with median days on market higher than that. So that's real change. And there are only 5 months in the past 10 years where median days on market have been at this level or above. And all of those months were in the winter. The only other months in the past 10 years where we've had 36 days on market or more were either December, January, or February. So keep an eye out. We'll have to talk about this next month as the data comes in. But things are slowing down. Okay. How are the new administration policies affecting real estate? So it's still too soon to tell the full impact. Like literally, we could be in the final 6 months of the administration, and I'll still be holding off my complete answer because we won't know what could possibly be going on and what could still have an effect. But tariffs and unpredictable policy. So the effects this is having are businesses are facing a profit margin crunch. Said this before, they've absorbed a lot of the increased costs from tariffs for now, but they can only continue to do so for so long. And those additional costs and uncertainty have caused them to pause hiring. That is having a meaningful impact in the economy slowing down a little bit. Softening the job market, like I talked about. So mortgage rates, we finally saw a little bit of mortgage rate relief caused by this soft jobs report. But in my opinion, mortgage rates are still higher than they would have been otherwise because of this volatility, increased inefficiencies. And nobody knows what to expect. So all markets depend on stability. Okay, now a bit of a change of pace. Just want to hit on this really quickly. This was a post my colleague Shelley shared with some of our Fulcrum colleagues, and I took a look at it, and it just immediately I was like, that's not possible. Like that's not the case. I didn't know specific numbers in my head, but I know from following this stuff that that's just not right. And so I went in and I looked. I pulled the data basically over that stretch and confirmed that these numbers are not accurate. Then I saw in the comments, he's only talking about east of 16th Street. So Russell, if you're watching this, I would love to hear your response to this. A little bit disappointed. I know you are involved in lobbying, and part of that is crafting a message and getting public support. But I also think that as in leadership positions in real estate, we are stewards of our industry and have a responsibility to present accurate data. So there's no doubt that this is misleading because you're not even talking about all of DC. You're only talking about east of 16th Street, where, so a little bit of clickbait here saying all of DC. And then here, the way this is presented, you talk about DC being currently a tale of two cities and implying that that is because of the current administration. And I just want to add that DC is a tale of two cities. And it's been a tale of two cities almost since it was created. I mean, there has been tremendous wealth inequality and division for quite a long time. And there are few cities where the haves and have-nots, and I only talk about that as far as like economic stability, where the dividing line has been so distinct. So this is not a new thing, but I wanted to dig a little deeper into this data. So I pulled zip code 20002, and that is I did that because I think that's the largest zip code east of 16th Street. I could be wrong, but it's a massive zip code, and it covers it covers Hill East, Kingman Park, Carver Langston, Trinidad, Ivy City, Eckington, just a huge part of the city. And I pulled up the data there. And what is happening? So what has been happening in a lot of the real estate market, and especially northeast, southeast, the section east of 16th Street, is pandemic related. It's been caused by the pandemic. So here you can see this goes 4 years back for this zip code, and you can see that closed sales have been down year over year, virtually every month for the past 4 years. This is not a January 2025, February 2025 new administration. All of a sudden, these policies are upending things. No, this is where, and I know Fulcrum, our office is in this zip code, and we have a lot of people who focus there, and they can tell you that this market has been softer for quite some time. And it's pandemic related. Up until 2022, we had seen DC's population increase every year for 20 years. And in 2020, the population decreased. I don't know if they're still I don't know if DC population is still at the level it was at pre-pandemic. And that's what's factoring in here. You can see active listings inventory has been increasing for years. You can see the up and down. That's like seasonal, cyclical. But it has been a steady ramp up for the past 4 years. And in this past 4 years, you can see there have only been 4 months where active listings have not been higher in a given month than they were the year before. So, a little disappointed, Russell. A little disappointed.
I mean, it's good for clickbait, but it's not good for we're the ones who we're in it all the time. Like we're in it every
Mhm.
day. And it's it's our job to present accurate information and not to clickbait people. Because we saw that in the beginning of the year. We saw people who weren't real estate agents putting out things like this. And they had to get their post removed. Like it was a whole huge thing
Mhm.
because
Mhm.
so many people were in an uproar over misleading information. And so
Yeah.
yeah.
And I mean, imagine you own a home in DC east of 16th Street and you see that.
Yeah.
And what if that prompts you just to oh, I have to sell, and then you try to sell right now, August, a slow time in a softer market, and you could lose some serious equity by making a knee-jerk reaction to what is happening. Okay,
Yeah.
3 takeaways. The takeaways have been kind of consistent because we're in this consistent level of unpredictable times, but staying ahead of the market is crucial. Following this stuff is more crucial than ever. The market is changing. The market is changing in meaningful ways. And feel free, like I said, join me every month. I also do a weekly market minute, which tends to be longer than a minute. I count on 2 or 3 minutes, but I'll give you kind of the key areas of the economy and the real estate market every minute. So even if you're not following it closely, just jump on here, follow me, and I'll give you the highlights of what you need to know. But it's super, super, super important because what you know from one week to the next and how you're counseling your clients, if that information is dated, there could be some clients out there making some mistakes or poor choices. Still a good time to buy. Takeaway number 2, like I said, DMV wide, we've seen price appreciation for 26 straight months. So the only thing that has happened, if you have a buyer who's been waiting for the past 2 years, is they're going to pay more for their home now than they would have otherwise outside of some parts of DC and other small areas. And then sellers still have the advantage. Like I said, sellers still have the advantage. DMV wide, we are still under 2.5 months of inventory. That is still a seller's market. If you are selling a property now, you still have the advantage relative to demand. But it is more important than ever to price appropriately. When I teach my classes, every single time I teach a class on pricing listings, I will pull up all listings within a half-mile radius of the location where I'm teaching the class. And every single time, half of those properties, it doesn't matter how hot the market is, half of those properties have been on the market for more than a month. There's no surer way to get a poorer result for your listing than to overprice it to begin with. All righty. That's all I got. That's an old picture of me. Got new headshots. Should probably update it at some point. But if you want the deck, drop a note in the comments and email me. Give me your email address. I can add you on the distribution list. If you like the content, the usual like, subscribe, hit that bell, whatever the young YouTubers say. And thank you for joining us all. Let me get that graphic out of the way, pull it back to just the 2 of us.
Thanks, Maggie.
Thank you, Maggie. I appreciate that. Temi, any closing thoughts? Any closing thoughts or comments from those of you with us online?
I think, especially if you're a new agent, these are the calls that you need to be on to be able to have these conversations on a monthly basis is incredibly powerful.
Wait,
Because
Temi, sorry to interrupt, but I
Mhm.
just want to say, like, one of the reasons I started this, and I've said this before, but I would be hanging out with other top producing agents and they would say things about the market that just weren't true. And I realized even a lot of top producing agents don't follow the actual data. I mean, they'll be in tune with what their core market is and what's happening with their clients, but that's not necessarily representative of what is happening even to the market in that segment. And so it's, yeah, new agents, it's even more important because of the learning curve in this industry and the fact that one of the best ways to develop your business as a new agent is you can outwork these other agents. You can learn more about what's happening. You can become the market expert. If you're hosting an open house, you can know everything that's happening in that little area, or you can study all of this stuff more closely than most agents do. So super, super important. And I would say, yes, more important for new agents, but still important for all agents. Okay.
Experienced agents. Yeah. No, no,
Apologies for the
no,
interruption. I'll go
no, no.
back to drinking my coffee.
I think the other day I was just thinking about how this would have been vital for me as a new agent. Um, so that's why I specifically kind of mentioned that. And so I'm so glad to see a lot of like newer agents on here. Especially, and then also right now it's really interesting to see how susceptible we are, as agents who work the market all the time, to either the news around us or just even to our clients. Like we may work with 10 clients and be facing something, and then that becomes world news, right? Like,
Mhm, mhm,
maybe we had a listing fall through, or we may had a, you know, I had a week where several, like I went under contract and several of my contracts fell through, and then that kind of becomes the story, right? Like, oh no, the market is falling because it happened to me, or because it happened to
mhm,
the smaller
mhm.
amount of people that I work with, versus really looking at the stats and changing the stories in our heads and in our and in our atmosphere, right? Like,
Mhm.
what is the real story versus just what we're seeing.
Definitely. Definitely. Well, thank you as always, Temi, all smiles, a Koji, my the how the size of your screen in my window is not sufficient to know whether that nom de guerre was earned today, but I trust it was because you are always all smiles. Love your positive energy, and thank you so much for helping moderate the chat, joining me on this journey. It's been a lot of fun. Thank you everyone for joining. If you joined but got on late and want the full package, as soon as we are done airing this, the recording will go up on my YouTube channel, Paul Knows Real Estate, and you can find it there. You can also find past sessions if you want to go back and check on some historical data. All right. I hope everyone has a wonderful rest of your week as we continue through these dog days of summer, and we will be catching you next month. Thanks, Temi.
Bye.